Good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast. Thank you so much for taking the time to join us. Today, we're going to look at and speak to the CPI data that came out, concerns around inflation and what investors should be doing about it, and how Barometer has managed the portfolios through this particular time in the markets. We've got a month and a half until the end of the year. So, David will be speaking to and providing us a macro overview. And of course, at the tail end of this conversation, we'd be pleased to address your questions. So don't be shy, hit me up on the chat or send me an email at phastings@barometercapital.ca. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you? Great to see you.
Always a pleasure to see you too, David. Looking forward to your
I can hear your dog in the background. He's obviously getting bigger.
Yes, that's two dogs. We're babysitting one right now, and they just decided that now would be a perfect time to be barking in the backyard. So I think one of them went into the pool. Anyway, I turn it over to you.
All right, great. Well, thanks everybody for joining us today. Lots to get through. Certainly inflation has been part of the conversation this week and what that all means for various asset classes and how investors should be positioning given some of the strength in the data. So let's talk. We'll start as always from the top. It's been our view that we're in a structural bull market in equities that started in 2013 in the US. Other world markets joined the party and made new highs over the last couple of years. But the US market's been rallying for about 8 years after basically going sideways for 13 years. So in a structural bull market, it tends to be 4 steps forward and 1 step back, and you do certainly have corrections, but they're more manageable. And we are always on the watch for risks and things that might cause us to get a little bit more cautious. And so we'll talk a little bit about that today. From a fixed income perspective, we think that we went through a generational bottoming in yields over the last 18 months, much like we did in the early 1950s, late 1940s. After the war, there was a spike in inflation, and then slowly rates started to pick up. Inflation did subside and didn't really pick back up again until the early 70s, but certainly bond yields started to work their way higher and did, for the next 30 years. From a commodity standpoint, we think we went through a generational bottoming in commodity prices in 2020 at the bottom of the COVID shutdown. And since then, we have seen some commodity shortages. We've certainly seen commodity prices move higher. And if we look at 10-year rolling returns, just really in a year, we've gone from a 10-year number that was minus 6% a year back to about flat. But that tends to be sort of what happens in the early stages of a reflationary environment. And then commodity prices often will outperform the S&P for an extended period of time. So it can be a very important asset class. It's one that is not well loved for sure. And certainly not in a world where we are, working at decarbonizing and being better with the environment. But in some ways, the green movement has caused part of this issue, given the fact that there have been limited new supplies coming on from companies in this space. So we'll talk a little bit about that. From an S&P perspective, this is the rally that began in November of 2020 after correcting in October, November. Solid advance through until late August, early September. Market corrected a little bit, as it often does. In fact, it was a pretty mild correction given the kind of rally that we had. But conditions are particularly favorable for equities. There's been lots of liquidity in the system. There's a ton of cash on the sidelines and continues to be, frankly. And investor sentiment in general has been quite cautious. Now it's become a little bit more ebullient over the last month, and we certainly watch sentiment, because sentiment can tell us about what might happen next. But at this point, really not enough to be concerned about. And the S&P, as you can see, as of about 15 minutes of the close, was trading at a new high. So seasonally, we're into a stronger period. If we take all the years from 1950 to present, it tends to be the market's quite strong to finish the year. Frankly, it starts the year pretty well too until sort of late April when you tend to get a little bit of seasonal weakness. That's conjecture. We don't make decisions based on that, but we're always interested to see how markets stack up from our standpoint versus seasonal patterns, and we keep a close eye on that. The NASDAQ, as you know, has been quite strong over the last number of years. It also corrected a little bit more in September and October than the S&P. Large cap tech really did go through a little bit of a correction, but has really come charging back. And while not quite at new highs, lots of companies, of course, are. And the impact of some of the very largest companies has had a muting effect on the NASDAQ 100. And we know that some of the mid-sized companies have been outperforming. Seasonally, from a mid-cap perspective, again, November through March, we tend to see relative outperformance versus the S&P 500. We talked a little bit about this over the last couple of weeks, and that's happening after several months of consolidation. The Russell 2000, which is well represented with mid-cap and smaller cap companies, broke out to new highs and looks to be quite strong headed into that seasonally stronger period. To put it in perspective, the rally that took place in the S&P, the last secular or structural bull market that started in 1981, lasted about 7,700 days and gave about a 1,500% return over that period. So that worked out to about 18% a year over almost 20 years. So it does feel as though this bull market has been going on a long time, and there have been interruptions that you may forget. 15, 16, 2018 was a good size correction, stiff correction in November, December, and then the correction for COVID. But this bull market has gone on about 3,000 days. So less than half of what happened in the 80s and 90s. The total return is at just about 600%, or about a third of what happened during the rally in the 80s and 90s. So this can go on a long time. We assess it day by day, week by week, month by month. Our job is to understand whether the market's healthy or not, whether we should be exposed or not. But just to keep it in context, these bull markets can go on a very long time. From our perspective, our breadth models continue to be very constructive. What we care about is, in a healthy market, we know a higher and higher percentage of stocks should be participating in a rally. If you had 100 companies in a market and over time you went from 20 of them being in uptrends to 30 of them being in uptrends to 60 of them being in uptrends, that's healthy. That's buying spreading across more and more issues. It means that there's appetite, and it means that there's money that can be put to work. And there's no bear market in history that ever took place while these kind of breadth readings were expanding. So the US market has about 64% of all of the companies in the NYSE in clearly defined upward price trends. And that's been rising since that little wobble at the end of August. It doesn't tend to be that markets get overbought or overdone until 70, 75, or even 80% of stocks are in uptrends. We're not near that now. And frankly, when you get there, that's a particularly strong market that you're in, because almost everything's doing well. It can be very productive. You still don't want to step aside until you start to see that number deteriorate. We're seeing in Canada about 50% of stocks in uptrends, and that is expanding also. And all of our short-term data, the percent of stocks trading above their 50-day moving averages, percent of stocks trading above their 150-day moving averages, percent of stocks making new highs versus new lows, and percent of stocks with positive weekly price momentum or upward trajectory, all of them slowly, steadily improving. To me, that tells me that there's a healthy backdrop. There are healthy shock absorbers in the market. And if you think of the market as being a giant machine with 1,000 moving parts, there's some obvious pieces, the news items we read about every day, that might impact markets. But there are lots of other factors impacting decision-making that can offset bad news. And if there's enough positives offsetting negatives, markets grind their way higher. And that's what's happening right now. So when we look at the data that we've had put in front of us over the last 7 days, things that sort of stand out to us, the conclusion of earnings season. We're almost through S&P 500 earnings, and there really has been no change to the trends this week. Very, very strong revenue growth year over year, about 18%, and about 38% earnings growth. About 80% of companies beating estimates. Consumer confidence came in this week. It was a weak number, and so people ask questions about that. And certainly the hot number of the week was the CPI number, and CPI came in at 6.2%, which came in above estimate, and certainly was one that people are thinking about. So from an earnings perspective, I think what's important is over 80% of companies through the course of the quarter beat their estimates. Companies on average beat the revenue estimates by almost 3%, which is positive, and they beat the earnings estimates by a solid margin. So around the horn, the numbers were good, and actually the way the stocks reacted to news was better than it has been in the last couple of quarters. So I think people maybe thought that inflation might cause some profit margin compression. In fact, that didn't happen, and lots of companies beat and exceeded estimates. So let's talk about the CPI data. This is CPI data going back to the early 1980s. And for those that were invested in following markets at the time, we know that interest rates in the real economy were very, very high in Canada here, mid-teens. And then Paul Volcker, by ratcheting rates higher, tightening the system, was able to get the inflation numbers under control. And we've lived in a regime of relatively very low inflation numbers for the last 20 years. Now, interestingly, we saw the lowest low in 2008 in the financial crisis. The next time inflation came down to zero was in the European debt crisis. And then we had the low that we saw at the pandemic low, all three of these higher lows. Now, something that I would say as a chartist and a technician is that if you see a chart of a stock that has underperformed for a long period of time and has gone through a long, low period of low volatility and has started to make higher lows, when eventually it tips higher, it doesn't tend to be something that is just, cursory. It tends to be something that's more significant. So I think that that's caught the attention of a lot of investors because that number did come in very hot. Now, there are several people, lots of folks who believe that this is transitory, including the Fed, if you listen to what they say. I listened to Morgan Stanley's global economist yesterday talking about the fact that they believe that inflation data globally for developed markets and emerging markets will peak in the early part of 2022. And they believe that because the bottlenecks in the supply chain, they believe, are starting to resolve. And I see some data that would support that. Container prices are coming down. The dry bulk shipping index is starting to come down a little bit. But there are other things in the economy that could have a bigger impact, like labor costs. And we've seen some big settlements from unions over the last short while. So we're certainly keeping an eye on that. We don't conjecture what we think should happen. Our job is to watch the market signals and take information away from that. The wisdom of the crowd ultimately generally figures things out early. And so we're watching the signals that we're getting from various asset classes to help us make those decisions. But certainly the inflation discussion is impacting investors. Now, if we look at very long-term data, and I don't want to get too far in the weeds on this, this is a chart that takes the Fed funds rate and subtracts inflation to get sort of the real rate of interest in the economy. And if you go back to the late 1940s, you had a spike in inflation, you had interest rates quite low. So if you took the inflation rate from the Fed funds rate, it came to a negative number of about minus 16%. So in other words, there were negative real rates in the economy. And what happened was, as we went forward, inflation picked up and interest rates started to rise. And we know they rose through until about 1980. The reason I bring that up is that recently we got to a point where the Fed funds minus inflation again, was at a significant negative number. So the question is, does this point to a rise in Fed funds rates or short-term rates? The bond market seems to think so. Could it lead to more inflation? It's possible. I don't know that, but we have to follow the clues. When we look at what investors care about, this is a fund manager's survey out of the US that looks at the key concerns that they face. And you can see that over time, this is 2015, people worried about geopolitical risks, the Eurozone breakdown. Then moving forward in 2015-16, that was the Asian slowdown, which impacted commodity markets and so on. We were worried about hard landing. Consistently over the last few months, the big concern has been inflation. So markets care. So let's talk a little bit about that. It's not our job to guess. It's our job to use our tools to try and find the groups within the market that are working in the current environment. We don't have to be everywhere. We're always watching for change. And in the event that an asset class shows us risk from our breadth perspective, we'll reduce weights, use our stop losses, and we won't put any new money to work. So that particularly applies right now when it comes to the bond market. We saw 10-year lows in yields in March of 2020. Yields started to move higher. They had a good move higher and then corrected through the course of this past summer. Found a footing at the long-term moving average, started moving higher again, and really have continued to do that. So there could be that people believe that rates are, going to be going higher. Could mean that it could be that they are moving higher because people have concerns that the Fed is getting behind the curve. But certainly it's caught people's attention. You see it even more in the 5-year yields. Let's just take a look here. So the 5-year yields have moved even higher. So this is from mid-2020. You see that the 5-year yields are pushing now to a new high. So this has an impact, and it's important to watch because it has an impact on bond prices and fixed income. So let's take a look at the fixed income charts. This is volatility. Now, we talk a lot about volatility as it relates to the stock market. And we can see that volatility for European equities and US equities, the VIX, are exceedingly low levels. When we look at volatility for the bond market, it's actually trading at a new high. So this is causing investors to move their feet in fixed income. And it's certainly something that I think is important. Now, for some reason, my computer is freezing. There we go. So let's look at some bond charts. This is an ETF that owns a basket of international treasury bonds. In other words, sovereign debt from outside the US. And we see that today we made a new low. When we look at we seem to be frozen. There we go. High dividend paying global stocks made a relative new low versus the S&P today. In other words, things that act like bonds are underperforming. Let's take a look at some other groups. There we go. This is emerging market local currency bonds. So they're making new lows and have been rolling over since late 2020. Let's take a look at well, I apologize. I'm going to ask you to hold just for one moment. Let's see if I can fix this. Okay. This is gold relative to the long-term treasury bond TLT. You can see that gold prices over the last short while started to work their way higher. And on a relative basis, gold started to outperform treasury bonds. So treasury bonds should move lower in price and higher in yield when we believe that either there is increased growth in the future or increased inflation. People have been confused by the fact that gold has had a muted return over the last several months. But as the inflation data has come in hot gold has started to pick up some steam. And there's the gold chart going back 2012 through 2020, consolidating, and as we talked about last week, turned higher. Not quite sure why everything is so hesitant. In fact, gold has been rallying in the past week against the yuan, against rupees, against Japanese yen, against euros, against US dollars, and against Aussie dollars. So these are all things that we care about. They're signals that tell us that we need to be concerned a little bit about inflation. It may be that it's transitory. It may be that it becomes muted at the beginning of the year. But in the very short run, we see signs. When we look at consumer staples relative to consumer discretionary or relative to the S&P 500, in both cases, they are making relative lows, and not just sort of on an annual basis, but actually multi-decade relative lows versus the S&P and versus the consumer discretionary universe. Let's look at cyclicals versus defensives. Cyclical sectors versus defensives, again, this week made a new high. Last week, the strongest group in the market was materials. So let's talk about sectoral themes, see if there's any change here. One of the groups we know that is most positively impacted by rising rates and potentially positively impacted by asset inflation because it strengthens the value of collateral at the banking sector. So as we know, the banks broke out of a multi-year sideways base in May of 2021 and sitting basically on the close at new highs. A few of our holdings here behaving extremely well. As loan growth has picked up, companies that have had strong loan growth relative to their peers are making hay. So Silicon Valley Bancorp, which we've talked about before, closed at a new high today. And First Republic also closed at a new high today. Loan growth for the first time in some time is picking up nicely, and that's going to give opportunity for earnings growth and in turn dividend growth. When we look at the asset managers, shifting gears within financials, still groups that benefit from asset inflation. Of course, the fees that they charge go up as the asset prices go up. CI Financial has been a particularly strong performer through the course of this year. They've also made some great acquisitions. There's a good chance their dividend could rise again. Blackstone, the investment management company focused in private equity, also has had a very good year, trading very close to the highs. So financials continue to perform very well. I think the market signaling from this area is really quite favorable. Let's talk a little bit about technology. Within technology, the cyclical parts or the more economically sensitive parts, the parts that have an ability to raise price more quickly, semiconductors continue to outperform software stocks. We've talked a little bit about the fact that we've got really good exposure in the semis. They continue to perform well this week. NVIDIA having a very good week. They report their earnings tomorrow. Broadcom trades close to a new high today. Lattice Semiconductor trading at a new high today, and Advanced Micro Devices trading basically right back to highs. So this group continues to do well. We also own SideTime. We own equipment companies, Applied Materials. So this is a group that I think continues to look quite good in an environment where there is some inflation. They can raise price. Cybersecurity continues to perform well. Cloud-based computing continues to perform well, all closing basically at highs today. Let's switch gears to another asset that might do well in an inflationary environment, and that's energy. Now, I recognize carbon-based energy is an unpopular sector from an ESG perspective, but frankly, the disincentive to invest in new projects is causing a shortage globally. It's possible this year we actually have a shortage of energy. The amount that we can produce can't meet demand, and there's real potential for rising prices. In general, energy companies are very inexpensive. We've done very well with Tourmaline. We've talked about Tamarack Valley. We've talked about Canadian Natural Resources. We've talked about Apache. This group continues to look quite strong. Some of them much stronger than the sector itself. In particular, some of the Canadian producers are very, very inexpensive because they became such an unfavored group. And as we talked about last week, just to keep in mind, a group that was 16% of the S&P in 2008 or 15% of the S&P in 1991 is 2.9% of the S&P today, certainly leaves scope for a higher valuations here. Sticking with the reflationary theme, industrials continue to act well. This is an ETF that is made up of mid-sized industrial companies. One of the negatives for the industrial sector have been some big companies like GE and Boeing. But when we look at some of the mid-sized companies, you can see the strength that's taking place here. We won't spend too much time there today, but that group is strong. And then moving into basic materials, we talked last week about the fact that copper continues to be in very short supply. We're well below the 5-year average, and the globe will be in a deficit for copper this year. Materials as a whole continue to act well through the course of the week. Some of the smaller sized miners really standing out, Foran Mining, for existent Capstone Mining, and Argonaut Gold this week, breaking out of a very long sideways consolidation period. So again, all of these are groups that would do well in a more inflationary environment. So consumer discretionary is outperforming consumer staples. The question is, why do we have any consumer staples? When I go through the holdings, I do get calls saying, you've been fairly negative on utilities and you've been fairly negative on consumer staples. Why is there a weight in the portfolio? Well, one of the great things about the market that we're in right now is there has been tremendous dispersion of returns. So in a healthy market, there tends to be a low correlation of one company versus others in its sector because the market isn't dealing with a big macro issue. Investors get to fundamentally choose the good companies from the bad companies. And while if we have an opportunity to have diversification, we want to, we aren't going to be overweight a weak group, but we like to have some weighting. And we've seen some strength in some of these groups. Fitting into the consumer staples group are Target and Costco. Now, both of them arguably have some aspect of consumer discretionary, but they continue to perform really well. Costco's earnings come in about 3 weeks. I think the street is expecting good, strong numbers. So consumer staples versus the S&P week, utilities versus the S&P week, US Treasuries versus the S&P week. So the equity asset class is one we want to be in because it's strong relative to these other areas. But we also want to try and pick our spots, as I say, in some of these weak groups, if there are some companies that are outliers. One of the companies we've held for a long time in the utility sector is NextEra Energy. And I only mention it because NextEra is the largest utility in the US in renewable energy. It's one of the highest growth utilities in the US. They have a good revenue growth, they have good earnings growth, and they have good dividend growth. So dividend growth rate has been a little over 10% a year over the last 5 years and looks to continue that way as they continue to build into wind and solar. In the consumer staples group, George Weston also doing quite well. And it turns out that when there is some inflation, often the consumer staples companies will raise prices and take some price and wind up with some higher profitability. I think that's one of the expectations here. So from a yield perspective, we don't really like the bond market. We don't really like assets that trade like bonds. We've been avoiding them through the course of the year. We have been focused in dividend growth companies because we think that those can help offset the impact of rising interest rates. And I've been putting this up each week. This is the RDVY ETF. It's made up of companies that have had a history of raising their dividends consistently. And while the dividend yield is lower, the dividend growth makes it very attractive. And again, we closed at a new all-time high today. So this theme continues to work. So when we talk about inflation, if we have concerns, here's where our exposures lie. Our biggest weight almost all year long has been in financials, almost 3 times the weighting of the S&P 500. It's been very consistent across banks, insurance companies, asset managers, all of them benefiting in a reflationary world. Technology has been recently an underweighted position because some parts of technology are very high multiple stocks that would be impacted negatively as rates go higher. Having said that, it's an enormous sector, and there are companies that are very economically sensitive and have business models that are accelerating. And so it still makes up 20% of our portfolios, but more so in those more cyclical semiconductor-like technology companies. Industrials, we've been bumping up in weight as that sector has been breaking out through the course of the fall. The profit margins have been quite strong. And again, due to inflation, some of these companies are taking the opportunity to take price. Almost 11% of our portfolios. Energy, almost 3 times the weight of the S&P at 10.75%. We took energy down a little bit because there can be some weakness in November, December, the shoulder periods between hot weather and cold weather. We'll see whether that plays out this year, but still a very significant weight. Materials, we've slowly been weighting up. And certainly in the last 2 to 3 weeks, we've seen a nice pickup in a number of areas in materials. So while it's still a relatively small part of our portfolio because they are more volatile by nature, they are a significant overweight. The other end of the spectrum, healthcare has been a significant underperformer. We have very low weights. We have very low weights in consumer staples, utilities, and telecom. We frankly have maybe too low a weight in consumer discretionary, but there have been some parts of consumer discretionary that have been difficult, also including travel and leisure. From a geographic perspective, we talked last week about the fact that the TSX, for the first time in many, many years, is outperforming the S&P, and that's important. When we talk about breaking out of a bear market, frankly, the TSX was in a bear market since 2008, tried multiple times to get up and out of the range, and finally did so only about a year ago. Now, the TSX tends to act a little bit more like emerging markets and other global markets than it does the US, partly because of the makeup of our sector weights. Large financial weight in Canada, large energy weight, large tech weight, large material weight relative to the S&P, large industrials weight. So it would make sense that if these sectors are leading, Canada would be doing a little bit better. And of course, we live in Canadian dollars, and Canadian dollar tends to firm up when energy prices are stronger and when material prices are stronger. So we do have a bigger weight than we would tend to have in Canada. In our macro portfolios, it's a multi-asset portfolio. We don't have to be in equities. We don't have to be in fixed income. As it stands, we do have some US equity exposure. We have some global equity exposure, and you can see a lot of these themes, which are reflationary or inflationary themes, are what make up this portfolio, including, a good sized position, which we've grown into in cryptocurrency, which in some ways is looked at as digital gold, has been performing quite well. More difficult day to day, but there are going to be bumps along the way there. And on the other side, short positions in US government bonds, global corporate bonds, global currencies. We're focused on Canadian dollar versus US dollars, utilities, telecom, and consumer staples and healthcare. So overall, we're pretty happy with how things have been going. That macro fund is up about 38% on the year, 73% over the last 1 year. Our equity fund is up about 47% in the last year. And frankly, the balanced funds are having a great go, and the income funds certainly performing well. So I think that we're well positioned. Now, there does tend to be a little bit of bumpiness in the middle of November leading into Thanksgiving. It shouldn't be anything significant. Our models are showing pretty healthy conditions. And then, of course, the market firms up into the year-end rally. So we'll watch for any signs that it's different this year. But as it stands right now, all of our themes, I think, continue to look quite good. And as we talked about, seasonally, November to April is the strongest period of the year. So with that, if there's any questions, Pam, happy to answer them. If things were to get sloppy, we're certainly happy to get defensive. But the hardest thing in a bull market is to stay in your winning positions. And so we're sitting on our hands and letting the market do the work.
Hi,
Pam,
Dave.
do we have any questions?
Yeah, fortunately, the dogs have stopped barking, so that's a good thing. I just wanted to thank you again for this great overview. And we do have one question. We have a series of three. So the first question is, does Barometer invest in any new IPO technology companies in Canada? And if not, does Barometer have a view on this segment of the market?
Yeah, so we absolutely do. As many know, from a bottom-up or stock picking perspective, Greg Guichon leads that team. I try and give macro targeting as to where we want to look for ideas. And then there's a team that works with Greg. Jim Skatakis focuses more in the US large cap stocks, and he has James Callahan working with him, who was on the call a couple of weeks ago. In Canada, we have Brian McNichol and Amit Joshi, and they both spend a lot of time looking at existing companies in the market and looking at potential new issues as they're coming along. So we do spend a lot of time looking at IPOs, both in the US and in Canada. Canada is a little bit more tricky than the US. It tends to be that the issues as they come in the US maybe are a little bit hotter, but there's some very, very good issues that come in the Canadian market. And we have several in our long short portfolio right now, smaller sized companies that are less well known. And in some cases, they've come to us by way of IPO.
Thanks so much, Dave. The next question comes from Stephen in Toronto. He wants to know, for those who might be 70 or older and perhaps more risk averse, where should they be looking for Barometer to be putting their money, given that bonds are so unattractive in the near term?
It's very tricky because we think about risk in many cases as risk that the stock market goes down. Another risk that you have to think about is that rates go up and you're sitting in bonds, right? So as rates go up, bond prices go down. And I think that that's a bigger risk for a lot of investors right now than they realize. In some cases, as I've talked about, people have hidden or tried to stay what they consider to be in low risk positions in things like utilities and real estate investment trusts and telecom companies, things that are not economically sensitive. Those companies right now are trading at 1.5 times the valuation of the average company in the S&P. So those sectors are the most expensive they've been since the early 1970s. And it's because they are so crowded and because people have looked for alternative sources for income. So I really believe that unless somebody's really concerned that they might run out of money between now and the time that they pass, if they're trying to get a risk-adjusted return on the money, my view is the best risk reward comes from the dividend growth cohort of equities. Because if companies have shown over time an inherent ability to raise their dividend consistently, that should give an income stream and some capital growth that will offset the impact of rising interest rates. The portfolios that we run right now, we're not trying to shoot the lights out and get the best return possible. We're trying to own assets that will protect us if inflation is an issue. And I think it's hard not to say that it isn't, right? So we've had governments around the world running the printing presses flat out. And as a result, in the US, there's almost twice as much currency in the system today as there was 18 months ago. So no wonder there's some inflation, there's cash around. And so we're trying to find things that can give us a rising stream of income. We're also looking at alternatives. And many might know that we just launched our second music royalties fund. And the reason that we like that is that they'll pay us sort of 6 to 8% in cash flow. But as more and more people become streaming subscribers, the royalties are likely to slowly grow. So that's an asset that we think can give us a rising stream of cash flow that will offset rising interest rates. But I think the most important thing is going to be diversification. If I pick asset classes, I'm not so interested in fixed income. I am interested in equities. Within equities, there are certain sectors that we talk about that I think are well suited to a more inflationary or reflationary environment, and certain they're not, consumer staples and so on. And then from an asset class perspective, we're looking at other things like music and some areas of real estate, like industrial real estate, where when the economy's stronger, they can raise their prices and raise the dividends that get paid out. So it's taking a basket approach to more reflationary assets. And these are assets that have not been widely held or focused on over the last number of years during falling rates.
Thanks so much, David. The next question, your thoughts on Lightspeed?
So Lightspeed obviously disappointed from an earnings perspective, and there is some concern out there, whether it's validated or not, the market cares. So the stock right now technically is probably broken and needs to do some repair work. So if it was one of 20 stocks for me in my personal portfolio, I probably would step aside and let the company get back on side before I put the money back.
Thanks so much, Dave. Well, you touched on the music royalty fund. So we've covered that question. And of course, we did touch a little bit on REITs, but do you have a perspective on the REITs market that you'd like to share above and beyond what you just mentioned?
Yeah, I just think that, real estate is a very diverse asset class, just like the stock market is. And there are parts of the REIT market that are more attractive in a stronger economy or an inflationary world, and parts that are more attractive in a disinflationary world. So when we think about industrial REITs, these are properties that are marketed to corporations that are producing things. And as industrial activity goes up, demand for that space goes up. There's a lot of demand for industrial property right now for distribution centers, as we know, and for warehousing and so on. And so prices can move higher there and the distributions can move higher. So we think that that's sort of the most interesting place. I think probably the least attractive place would be office REITs. Interesting, I was looking at a survey of cities across the country, and I think that in Canada in general, about 80% of people are back at work. In downtown Toronto, it's about 20%. So, and that's sort of flattened out. So that may just be that people are still concerned with COVID, but the occupancy levels are not coming back in a hurry. There's a lot of real estate that's pretty empty. I'd be a little more cautious there.
Thanks so much, David. Well, that concludes our questions for this afternoon. As always, we'd like to thank you for taking the time and sharing your insights. It's like an inside look at what's happening in real time at Barometer. So I know that our investors and certainly prospective investors appreciate your viewpoint. As always, I will leave you with the final word. And dogs have stopped barking. They were very excited to be participating in this webcast, David. So hopefully it wasn't too much of a distraction.
Well, listen, I want to thank everybody for joining us today. Once in a while, you get some technical glitches, and we did early on. So thanks for sticking with us. I think that we just have to stay vigilant. And when there are perceived risks, we spend a lot of time looking at them from all angles to see how they could impact us in the portfolios. And sometimes the risks aren't the risks that you expect. So as it stands, it looks like we're sort of steadily moving forward here. And if you've got any questions, either about the portfolios we're managing for you, or in fact, if we're not working for you, but maybe we should be, certainly don't hesitate to reach out. If you've got questions, we're happy to answer them. So thanks very much for joining us, and hopefully you'll join us again next week and the week after that. Thanks, Pam.
Thanks, David.